What's up, Pennybois and Gals? It's your boy, What the Duck here, and it's time for another trading class video. Today, we'll be going over moving averages in detail. Last class, we went over indicators that can show us support and resistance levels. We went over the donchian channels, ichimoku cloud, Bollinger Bands, ENV, the keltner channels, and moving averages. Now, I know what you're thinking. We already went over moving averages last class, so why are we going over them again? Well, last class was about indicators that show us support and resistance levels, and moving averages do show you that. However, there are so many other things that moving averages can show you. For instance, the Bollinger Bands can show us support and a resistance level, which is why we went over them last class, but it can also show us if the stock is overbought or oversold, which is why we'll be going over the Bollinger Bands again during our overbought and oversold class. Now, I'm sure a lot of you are already familiar with moving averages and how they work, so this might be a refresher for some of you, but for those of you who do not know what moving averages are or how they work, the first thing that you'll need to know is that there are two types of main moving averages: the SMA and the EMA. The SMA, which sometimes is referred to as just the MA, is known as a simple moving average, and the EMA is known as the exponential moving average. So first of all, what is a moving average, and what are they used for? Moving averages are used to identify trends and confirm reversals. So what I mean by identify trends is figuring out if a stock is trending up or trending down. When I say confirm reversals, this means trying to figure out if a stock that is currently trending up is about to start trending down, or of course vice versa. Moving averages can also show you different points of support and resistance levels like we went over in last class. What the moving averages can also tell us is the average price of a stock over a certain period of time. Just like other indicators, this is figured out by a mathematical equation. The moving average takes the sum of the closing price over a certain period and divides it by that number of periods. So if you're looking at the 10-day moving average, it will take the sum of the closing price over the past 10 days and then divide it by 10. So now that you know that, you can see how moving averages are based off of past prices and mathematical equations, which is why it cannot warn you of anything in advance or tell you what is going to happen in the future, but instead it can help confirm if a trend or a reversal is taking place based off of the past trading numbers. Like how statistics in sports can't tell you exactly what's going to happen in the future, the same thing goes with these indicators. In baseball, you have a batting average. In football, you have a passer rating. In basketball, you have a free throw conversion rate. These are just mathematical equations mixed with stats, those stats being their past performance in prior games. And they put those stats into the mathematical equation, and then you have your batting average, or your passer rating, or your free throw conversion rate. They can tell us how a player has done in the past, but just because a player has done well in the past, maybe they have a good batting average, or a good passer rating, or a good free throw conversion rate, it doesn't mean that they are guaranteed to get a base hit, or complete a pass, or sink a free throw. Just because an indicator is telling you one thing does not mean that it is going to happen, because anything can happen in the stock market, just like anything can happen in sports. Typically speaking, if the price is above the moving average line, there is an uptrend happening. If the price is below the moving average line, there is a downtrend happening. When the price breaks above or breaks below the moving average line or crosses the moving average line, this is known as a possible trend reversal, which means that the current trend might be starting to reverse. So for an uptrend, this might be going to a downtrend, and the other way around. So in simpler terms, if the price crosses over the moving average line, it might be a good time to buy. When the price crosses below the moving average line, it might be a good time to sell. The close of the candlestick is the price used to determine the moving average. So that means that the price that the stock ended up at during a certain time period, be it 1 minute, 5 minutes, or 1 day, or whatever chart you're looking at, is what determines the calculations for the moving average. So when it comes to the actual calculation of the moving average, they're taking the close of the past however many days, not the open, not the wicks, the close. The close of the candlestick is also what determines if the price has broken the support or resistance. So that means it's just because the price went below a certain moving average, if the candle did not close below that moving average, then technically it did not break the support or resistance, did not break that moving average line. So if the wick goes below the moving average or above the moving average, that's not breaking it. It has to close below or above the moving average in order for it to be a break or a reversal. The longer the time factored in, the stronger the support and resistance. So for example, the 200-day moving average can be looked at as a stronger support or resistance than the 20-day moving average. Also, the longer time period the moving average holds as a support or resistance, the more significant it is when it is broken, and the stronger of a support and resistance it is, the longer it holds. So the 200-day moving average was used as a support for a day, and then it gets broken. That's not as significant as it would be if the 200-day moving average was used as support for 3 months, and then it was broken. But the longer it held as support, the stronger it is, and the more significant it is when it gets broken. So if the price is above the moving average is the support. If the price is below the moving average is the resistance. And once the support is broken, it becomes resistance, and vice versa. If your stock is below the moving average is your resistance. It's the ceiling, which is, if it's higher than the ceiling, it's resistance, lower is support, floor. So if your price is below the moving average, then the moving average is your resistance. Once your stock goes above that moving average, now that moving average, it broke the resistance, but now that same moving average is a support. The more people that use a certain moving average, the more often it will act as a support or resistance. So this is called a self-fulfilling prophecy. So for example, if 95 out of 100 traders are looking at the 50-day moving average, certain stock as a support, well then the chances of the 50-day moving average will act as a support is greater. If only 5 out of 100 traders are using the 50-day moving average of that stock as a support, well then it's not so strong of a support because only 5 people are using it. This is because the stocks only go up and down based off of traders selling and buying. So if everyone is selling and buying at a certain point due to a certain indicator, well then that indicator will be a very accurate representation of a trend or a support and resistance. But if no one is buying or selling based off of that indicator, no one's using the indicator, then that indicator will not be an accurate representation of a trend or support and resistance. That's why it's called a self-fulfilling prophecy. Okay, so what's the difference between the SMA and the EMA? Well, the SMA, or simple moving average, shows long-term trends. It has more lag than the EMA, which makes it slower to react to price changes, whereas the EMA, or exponential moving average, is typically used to show short-term trends. It responds faster to price action and responds quicker to shifts in sentiment, which would be supply and demand or news events. It has a little bit of a different calculation than the SMA, which is why it is quicker to respond to price change, and typically makes it closer to the current price than the SMA would be. So EMA shorter term, SMA longer term. Some commonly used time periods or settings for the SMA, also known as just the MA, are 10 to 20 for your short-term trends, 50 for your midterm trends, and 180 to 200 for long-term trends. I personally use 10, 50, 180, fully up to you what you want to use. Sometimes I'll add in the 20-day moving average as well, or I'll just use the Bollinger Bands to see what the 20-day moving average is, because like we went over last class, the middle line in the Bollinger Bands is the 20-day moving average with the default Webull settings. The EMA settings is really based off of trader preference. They are usually smaller numbers, anywhere between 1 to 10, 1 to 20, or sometimes even 1 to 50. So when do you use the SMA versus the EMA? Well, the EMA is used for short time frames or a fast moving stock. Sometimes it's even used as day trades. And the SMA can be used for long-term holds or to filter out the noise and determine overall market directions. So how do you use moving averages? Well, last class we went over how when a price is above a certain moving average, that moving average can be the support, and when the price is below a moving average, that moving average can be the resistance. There are other ways of using the moving average as well. One way for day trading is waiting for the moving average or for the price to break a certain moving average, and then that price that the stock was at when the stock broke the moving average can be used as your support. So let's just say that you're looking at a day trade that's, the stock's at 50 cents and it just broke above the 10-day moving average. What you can do is that 50 cents, because that's when it broke, can be your support level. So, because once it breaks the line is now the resistance. So you can either, use that 50-cent line where it broke as your support, or you can just continue using the line as it goes up with the stock as a support. That's totally up to you. Another way to see if the stock is trending is when a bigger moving average is below a smaller moving average. This can show an uptrend, and vice versa. This is because the 200-day moving average takes into account the past 200 trading days. So if the 200-day moving average is below the 50-day moving average, this means that the price has been trading higher over the past 50 days than it has over the past 200 days, meaning that the stock has been going higher recently than it was in the past, hence the uptrend. If the 200-day moving average is above the 50-day moving average, this means that the average price of the past 200 days is higher than the average price of the past 50 days, which means that the stock has been trading lower recently than it has in the past, which is why it's in a downtrend. When a moving average crosses another moving average, this can show a possible reversal. So if the 200-day moving average crosses below the 50-day moving average during an uptrend, this can show a possible reversal, meaning it might start trending down. Some traders even use the Fibonacci numbers, which is 5, 8, 13, 21, so on and so forth, to select their moving averages, especially for the EMA. But the numbers that you use are always up to you, and it takes trial and error to see what works best for you as a trader. Not everyone is the same. Just like in baseball, a heavy bat might work for one hitter and not the other. A certain lacrosse or hockey stick might be best for one player, but might be the best fit for another player. Trading is not one size fits all, which, like with so many aspects of trading, whether it be testing your plan, testing out candle patterns, or practicing with indicators, paper trading will be your best friend when learning new things in the stock market. The stock market is like anything in life, it takes practice to get good at. That's why lawyers start out with mock cases and then small cases. Doctors start out with mock procedures and then small procedures. Traders start out with paper trading and then slowly put in small amounts of money into the market. Also, that being said, lawyers and doctors, they go to school first before they do any cases. So that's also a good thing to know. That's what you're doing right now in PBU, is learning. It's really important to learn first before you even start practicing. It's important to know that moving averages are backwards forward-looking by nature. So while EMAs can reduce the lag effect on developing trends, they still rely on past data that can never be applied to the future with complete confidence. So you cannot use a moving average to tell you what's going to happen in the future. You can only use it to see what happened in the past and kind of gauge that a trend or a reversal might be happening based off the past. But like I said, anything can happen. You can't use moving averages only to be a great trader. You need to learn how to mix and match moving averages with other indicators as well, such as RSI and MACD, which we'll be discussing in detail next week. I hope that y'all enjoyed this class. We have our live stream Thursday, 9 p.m. Eastern Time Zone this week. This is going to be going over the homework from this week and doing a Q&A on what we went over in PBU. Then we have our last 2 classes next week. We'll be going over KDJ, MACD, volume, VWAP, and support and resistance indicators. Then the week after that, we'll be doing reviews all week from all the past classes to prepare for the test. Remember, the quizzes and tests determine if you pass PBU and become a PBU graduate, and you get all the perks that go along with that as well if you become a PBU graduate. So make sure to get your quizzes done, but until then, I hope that you all make some bread.